Good day, this is your European Open briefing for Thursday, June 30th, the last day of the month of the first half and the second quarter. My name is Michael Florentiades, I'm the Chief Economist here at xm.com. And the key points that you should be aware of today: sterling continuing its rebound following the Brexit losses on last Friday. Stocks and oil gained on fading Brexit concerns, however, so we had a strong move in stocks and oil prices, a strong move up. And we have a busy day today. We have Japanese industrial output, we had released overnight, German retail sales, French inflation. We are looking forward to UK GDP for the first quarter, a revision, Eurozone flash inflation, United States jobless claims, and Canadian GDP for April. As we do these days, we start with the cable. Pound dollar crossed above 135 yesterday. 135.33 was the high. That was quite a bounce from the low of 131.33, I think, which was marked earlier at the beginning of the week. Overall, the markets feel that Brexit is manageable right now. At the same time, little clarity has emerged from the proceedings, both on a domestic level within the UK and for the relationships between the EU and the UK. So this looks more of an adjustment from the initial reaction rather than reflecting any fresh developments right now. We also had a strong rally in the S&P 500 yesterday. The US stock market benchmark, it was up by 1.69%, adding to the gains of the previous day, strong gains the previous day as well. So risk appetite is rebounding. As we said, Brexit is seen as manageable, particularly for the US economy and the US stock market, and as the Fed is now looking to delay hikes further. So the earliest maybe for a Fed rate hike right now is December. So stocks are saying we're in a bit of a sweet spot. The US economy is looking to be on a firm footing. Plus the Fed is not going to raise because they're worried about Brexit after effects. So stocks are rising right now. Support is also coming from lower government bond yields. So if somebody needs income, they have a few places other than risk assets to find it. And however, we have to say that the move might be premature, this rebound, but it does reveal very positive psychology in the stock market. Whether that psychology is grounded on real fundamentals remains to be seen, but definitely the mood in the market is to disregard anything negative and see the positive side of what is happening. We had some data out of the US yesterday, particularly personal income and spending, together with the PCE deflator. Spending in particular was strong. Spending is the blue line over here. And previous months already high figures for both spending and income were revised up. Income, growing at a smaller, the slower pace, and spending, which brought down the savings rate a bit, although the savings rate is holding on to relatively high level. We should also have a look at the core PCE. It's around 1.6%. It didn't pick up from 1.6%. And inflation as a whole below headline inflation, headline PCE deflator is below 1%, so it dipped slightly from the previous month's reading. Now, pending home sales did disappoint yesterday. They were worse than expected, but overall the US economy is looking in good shape during the second quarter, as consumption during April and May was very strong. So some analysis is suggesting that the GDP growth during the second quarter is going to be in the region of 2.5% to 3%, versus relatively slower 1.1% in the first quarter. These are annualized rates, by the way. These are not quarter-on-quarter rates, but it's a quarter-on-quarter rate annualized. Now, looking at oil, we had a bigger than expected draw in US oil inventories yesterday. You can see from the chart the big rebound from Monday. What happened to oil? It dipped all the way to around 45.80. Now it briefly touched $50. It didn't manage to break through $50 yesterday, WTI. So it's a very interesting development in the oil market. Brent crude is already above $50 a barrel, so this is helping. We see this relationship between oil and stocks feeding off each other's strength when there is a strong move in either asset. So just as with illustration, we look at the Canadian dollar. It has pushed the US dollar back below 130 on the back of the strength of the strong oil price. So you see the big move because of weakness in oil prices after the Brexit referendum, but now it's pushing the dollar back below 130. On to the busy calendar that we mentioned, you have the industrial output in Japan. It was much weaker than expected at minus 2.3% month on month. The expectation was for a drop of minus 0.1%, but we did have much stronger than expected housing starts. The year-on-year figure came in at 9.8% compared to 4.8% expectation. German retail sales were mixed. Strong month-on-month figure, weaker year-on-year figure. French consumer spending was missed expectations. It was down 0.7% in May. We'll see what will happen in June when as the Euro Football Championship was underway in France. Inflation was in line with expectations in France. We have German unemployment numbers released just now. I think they were close to expectations from what is happening, and we are looking forward to first quarter GDP for the UK. Just a revision. It's not expected to be revised neither up nor down. Crucially, we have Eurozone inflation. Eurozone is expected to come out of deflation, and headline inflation is going to be flat at 0%, and also core inflation is expected at 0.8%. Moving on, we will have jobless claims during the US sessions at 267,000, expected to rebound a bit from last week's 259,000. We also have Canadian GDP, the monthly GDP figure from Canada. Chicago PMI might be looked at, and don't forget tomorrow's heavy load of Japanese data during the Asian session. That's all from me today. Thank you very much for watching, and have a great day.